Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney and Alberta Premier Danielle Smith are expected to reveal a plan in Calgary today for Alberta to raise its emission price to $130 per ton by 2040. This move comes after Alberta froze its industrial carbon emission price at $95 last year. This move also works to fulfill a pledge between Alberta and Ottawa in November that included a carbon price plan in order to build a pipeline to the West Coast. U.S. President Donald Trump says a lot of problems with China were settled, and he called his relationship with Chinese leader Xi Jinping a strong one. The comments come as Trump concludes his trip to China, where he had hoped to get Beijing's help to convince Iran to open the Strait of Hormuz. Chinese President Xi sought to get the U.S. to agree with China's stance against Taiwan, and although no concrete deals were etched on either side, the two leaders walked away on stable terms. And shares of Interfor are taking a hit today. That's after sales in the latest quarter fell short of expectations, with revenue falling 13%. Weaker lumber markets are continuing to pressure the forestry sector. The Vancouver-based lumber producer says it expects continued volatility in North American lumber markets as the economy continues to adjust to shifting policies, tariffs, oil price instability, and other geopolitical uncertainties. And we're watching the TSX today. It is losing a lot of ground here, down 1.5% at the moment, well below 34,000 at this point. We'll continue to watch that. There's a bit of a sharp sell-off happening here, both on the TSX and in U.S. markets as well, which we're also watching. Trading today, our traders maybe not seem as optimistic today. You can see the S&P 500 down almost a full percentage point, and the NASDAQ down even more than that. AtkinsRéalis reported a beat in revenue yesterday, led by growth in nuclear. And here to talk about that and more is Rebecca Telcher, Portfolio Manager at New Haven Asset Management. It's great to have you join us.
Hi, nice to have you. Nice to see you as well.
Yeah, great to see you. So we'll start with AtkinsRéalis and the latest Q1 results coming out. What stood out to you, I guess, first of all, in this latest earnings report?
Yeah, the only I think the beat was really only due to its exposure to nuclear. I think if you compare the results of AtkinsRéalis relative to the other engineering firms, I mean, you see a stark difference in the performance. I mean, WSP is down more than 20%, same with Stantec, same with AECOM in the United States. AtkinsRéalis is the only one that's been able to maintain, it's only down, I think, 5% year to date. And it's just showing that strength in nuclear, like that seems to be the crown jewel. And, it seems to be one of the main sectors in the engineering space that has these hard assets. So AtkinsRéalis is the original equipment manufacturer and exclusive license holder for the CANDU reactors. They have that end-to-end engineering and management across the entire nuclear life cycle. So basically any new nuclear growth or deal is going to have some exposure for AtkinsRéalis, and so I think that's why the stock is reacting more positively versus the other engineering firms that are facing weakness from this whole AI disruption.
For sure. And obviously, like as you say, most of that strength coming from the nuclear side of things, because there's nuclear demand right now is quite high. It seems to be only going higher. Is that positive, I guess, for a further outlook for AtkinsRéalis moving forward?
Depends on what your views of nuclear are. So for us, I mean, we're pretty positive. I mean, if you look at the technology space, all of this AI, I don't know who the winners and losers of AI are going to be. I know they all require a lot of power and the increase of power demand, and we're seeing that. And that increase in power demand is real. As much as I want that new power to be coming from renewables. Unfortunately, we don't yet have the technology to efficiently store renewable power, at least in a large scale efficient way. So in the meantime, we need reliable baseload energy. And so for us, like in our opinion, that's going to be coming from nuclear and natural gas. And so as a result, we have exposure to both. We don't own AtkinsRéalis in particular because valuations have been very high. The dividend yield has been low. What we did own or do own is shares of Aecon. And so like Atkins and Aecon, they kind of work together. One of them provides the engineering, the other one does the actual physical construction. We've owned Aecon for years. We owned it when it was yielding 6% because we like the nuclear exposure. We also own Brookfield Renewables that has, a large ownership in Westinghouse that does the nuclear refurbishments as well. So, for us, we do think that there is further growth in the nuclear space. I know others maybe feel differently, but in the meantime, I mean, the surge in power demand is real, whether it's going to be from, growth in AI, and data centers, or if it's going to be, growth in reshoring and bringing manufacturing back home, or just replacing, coal plants with new, less emission-based baseload energy. So we do think nuclear has a place.
I want to move on now and taking a look at the markets because the Nasdaq up 12% in the past month alone. Obviously, it's a different story today. We're seeing a bit of a sell-off. But you say the recent resurgence in optimism is surprising when it comes to the markets. Why do you feel that way? Many reasons. And anyone who's followed me known I've been skeptical of the technology space for a long time. I mean, for better or for worse, because at the end of the day, we missed out on 12% performance this month, but I'm okay with that. I think what we've seen in the past year is just how vulnerable the tech sector can be to swings and volatility, whether it's from valuation compression or if it's from legitimate fears. So look at what happened to the software stocks since the beginning of the year. They're down at least 20% because of, again, that AI disruption fear, similar to what the engineering firms that we spoke about earlier. So let's look at the two largest tech darlings in Canada. So Shopify is down, 36% year to date. Constellation Software down 20% year to date, down 48% over the past year. Constellation Software has other issues as well, but I think a lot of it is that fear or that market anxiety that AI is going to disrupt the software space. So I think it shows just how vulnerable these stocks are to news that comes out, and it also shows, at the end of the day, what's the valuation backed by? And for a lot of these software companies, it's 100% goodwill or intellectual property. And that's what we're seeing. I think a lot of reason why investors liked the technology space, for the past 10 years is because they were asset light, and asset light companies generally will generate higher returns because they don't have hard assets. For us, we've always migrated towards harder assets, real assets, for example, pipelines and utilities. And yes, while that growth may not be, we're not expecting these names to double in a year, we prefer that solid, steady growth, that hard asset that actually that's backed by true value. Often these assets are irreplaceable. No one is going to show up and start building a new utility distribution when there already is one that exists. No one's, as much as I can wish, it's not going to, no one's going to be putting a new pipeline in the ground in Canada in the next year or so. So the pipes that are already in the ground are pretty much irreplaceable. So for us, we prefer the value of hard assets. And I think we're starting to see the vulnerability that you can have with soft assets that you don't have with hard assets. I don't think anyone is worried that AI is going to disrupt the pipeline or utility space. Okay, we'll have to leave it there. Rebecca Telcher, Portfolio Manager at New Haven Asset Management. Appreciate your time. Thanks so much.
Thank you so much.
Coming up next, Xanadu Quantum Technologies reported its inaugural first quarter with mixed results. We'll speak with its CEO on that next. Stay with us. Xanadu Quantum Technologies has reported a bigger than expected loss while revenue topped estimates. The company had a whirlwind start after publicly listing on the NASDAQ and the TSX, with it skyrocketing, and then on May 4th, it had a major drop. For more on that reaction, we sat down earlier today with Christian Wiedbrook, CEO of Xanadu Quantum Technologies.
I would say that we've always taken a long-term view here at Xanadu, particularly with quantum computing. So we try very hard not to look at the stock price and really thinking years ahead. So anything it does in the meantime, we try to just keep focused on what we're doing here in building photonic quantum computers. I would say too, a drop is really not unexpected when you have a small float, which is a characteristic of doing a de-SPAC process. So things are going the way they should, and we're really excited about the future.
Yeah, I take your point. A drop isn't necessarily unexpected, but that was quite a drop, right? Like, did you think that was a sign that early investors were kind of heading for the exit?
No, we've got some great investors. I think the key point there is that there's little float, so you can see dramatic upswings as well as low swings, as we've seen. Really, honestly, I think the more float we have, the more stable the stock will be. And it's a characteristic of a de-SPAC as well as quantum computing as well. So we're looking forward to the next year and the years ahead.
Did you sell any of your shares during that sell-off that we saw?
No, we're actually, myself and all the employees and early investors, we have a 6-month lockup period.
Got it. Okay, so let's move on to your latest earnings results, your first one since listing on the TSX. What do you think is attributing to the kind of mixed results that you're seeing?
Honestly, it's really hard to pinpoint one particular thing. As mentioned, we think long term here, so we look to the future in terms of what could be happening today. And honestly, since we've gone public, it's really hard to pinpoint. Certain things may get the stock excited, and other things may bring it down a little bit. I do think that the small float is one of the big reasons there. But honestly, this first earnings call, we believe it went well, and really it was not that long since we've gone public. So it's more about reiterating our story, our unique photonic-based approach, first photonic company that's actually public, and also our Penny Lane software stack, one of the most widely used ones anywhere in the quantum world. So really it was an opportunity for us to reiterate those two things.
Mm-hmm. And I do take your point that you're looking long-term, but the latest results show like very strong revenue growth, but losses are widening as well. So how should investors kind of balance out those two things?
I would say a couple of things. It's a great question. Revenue is not our main driver here over the next couple of years. We've been very clear with that with investors, and I think it's resonated with investors. What is important is our hardware milestones and our hardware roadmap, achieving what we say we're going to do from a hardware point of view. And also, it's more about partnerships than revenue. So having long-term partners that will stay with us over the next couple of years, that will ultimately be our first true customers once you have a large-scale quantum computer. We've ultimately said no to short-term revenue of selling single system quantum computers. We're focused on the large-scale quantum data center. And the intuition there is that these small systems are no more powerful than GPUs. So let's keep our eye on the prize and build a large-scale quantum computer that will hopefully change the world and bring in dramatic revenue at that point in time.
Yeah, I want to talk about the future of quantum in the market, because when you saw the spike in your shares at the end of April, early May, that was after NVIDIA echoed confidence in quantum computing. Do you think that will be a replicated phenomenon or just like a blip in the market? Like, what is the long-term outlook for quantum on the market?
Yeah, great question. I would say that we've seen these blips before, and NVIDIA has been involved in them in the past year and a half of the public companies that were already existing before we went public. I think we'll see more and more of these things over the coming years, these blips that drive the stock price up. And that's a function of people trying to really understand quantum computing. I think our investors and investors in the quantum space really know that this is a long-term play. We aim to build our quantum data center by 2029, 2030. So it's not next year, but it's not too far away. And so the real investors that understand this space understand it's not going to be something tomorrow. But every now and then you'll see some big news that, like NVIDIA announcement, that really drives the stock up. One of the things that we're very clear with our employees is we say, just get back to work, just focus on 2029, 2030, building this large-scale quantum computer. Assume there's volatility in quantum stocks, and things will eventually settle down, but have a long-term mindset.
I know, because 2029, 2030, as you say, it's not that soon, but it is not far away. That's a pretty tight timeline. Are you on track to meet that?
We are on track. What we've tried to do with our earnings call is really be as open and honest as possible. And the reason I bring that up is we're on track for 2029-30. Note that we didn't say 2029. We do give ourselves some grace there for building this large-scale quantum computer or quantum data center. And there's uncertainty there, and it's important for investors to know that. But investors like this because they know that quantum computing is one of those few technologies that will change the world. It's deep, deep tech. We really are storing, manipulating, and measuring information at the quantum level, which is very hard to do. So I think there's a grace period with quantum stocks, including Xanadu. But our strategy is be as open as possible with our timelines. And getting back to your question, we have been on track, and we hope to continue to be on track in the coming years as well.
Penny Lane is one of the most widely used quantum software platforms. It's free today, but it can lead to monetization down the road. I'm wondering, maybe you can explain to our viewers, because as you say, there's still a lot of understanding that has to go around quantum. Explain what Penny Lane is and the timeline for that monetization.
Yeah, for sure. So Penny Lane is essentially the operating system for quantum computers. It's the way you log in and program quantum computers. And it's ultimately the way that customers will log in and use our quantum data center in 2029, 2030. So, for your viewers, think of any hardware we have, whether it's our computers or phones. You need software to interact with them, and the same is true for quantum computers. So that's what Penny Lane is. As you mentioned, it's one of the most widely used software offerings anywhere in the world. It's also agnostic, so meaning that customers can use our hardware, our photonic hardware, if they want, or if you're, attuned to some other hardware, Penny Lane will also operate on that as well. So it's been very successful. It's in over 150 universities around the world in over 30 countries, and people have a true love for Penny Lane. And so we haven't announced anything yet, but with any open source model, not even quantum, but go back, for decades now, there is the ability to monetize open source software, well-worn path through services or tiered offerings for enterprise offerings and so forth. So we are considering all options at the moment, so stay tuned on that.
That was Christian Wiedbroek, CEO of Xanadu Quantum Technologies. Well, Prime Minister Mark Carney and Alberta Premier Danielle Smith are expected to make an announcement very shortly, just in about 10 minutes or so, on a joint energy deal. We'll have more on that after the break. A long-awaited national electricity strategy announced yesterday by the Prime Minister. It's a significant plan to double the grid by 2050 and in the process transition to a low-emission economy, create jobs and bring consumer costs down. CTV's Abigail Beeman breaks down the proposal and whether it can be accomplished.
The Prime Minister amped up to deliver a long-awaited electricity strategy with a plan to double Canada's capacity.
As our industries expand, our economy grows, AI accelerates, electricity demand in Canada is expected to double by 2050. So we will double our grid.
The government estimates the expansion could add 130,000 high-paying jobs by 2050.
This announcement in electricity, as far as I'm concerned, is the greatest announcement since, well, electricity itself.
Canada's current electrical system is complex and siloed. The Prime Minister concedes it's often easier to trade power with the United States than interprovincially, costing Canada billions.
Tying our grids together, that will be essential, and that's where the federal government has to come in and help the provinces make good choices that work strategically for the nation.
80% of our electricity from non-emitting sources. Most of that's hydroelectricity, some nuclear, and then there is some natural gas that is regionally very important.
Especially important in Western Canada. So to help build and power an expanded grid, Mark Carney is proposing to loosen Trudeau-era regulations to allow a scale-up of natural gas.
It is a betrayal of the years of time that was spent with stakeholders and utilities and Indigenous nations on developing the federal clean electricity regulations.
He re-announced the same electricity plan that the Liberals have used over the last decade to jack up the cost of power bills by 35%.
While the government promises this will eventually lower bills, it pegs the overall price tag of an expansion at more than $1 trillion and couldn't provide any details about a breakdown or who will pay for what.
That was CTV's Abigail Beeman. Well, joining us now with more is Chris Severson-Baker, Executive Director of Pembina Institute. It's good to have you. So we're waiting for this announcement today. It's about 10 minutes from now. We know the nuts and bolts of it. Sources saying Alberta expected to raise its carbon emission price to $130 a ton by 2040. I know the Pembina Institute has signed a joint letter with a number of different other organizations to the Prime Minister to emphasize the precariousness of the current moment. Can you talk about the precariousness of the moment?
Yeah, well, I think what we're about to hear, unfortunately, is a broken promise around the climate commitment that was made by Mark Carney when he introduced Budget 2025, which was to strengthen industrial carbon pricing in Canada and ensure that it starts doing what it was designed to do. Because what we're expecting to hear is that the ineffective system that exists in Alberta, in particular, is going to remain in place for the next 5 years. And then essentially it'll be up to a future government of Canada and a future premier of Alberta to potentially follow through with modest increases to industrial carbon pricing up to the levels that will be described in the agreement today. And so it's a major setback for addressing climate change, and I think it's for Canadians and for Albertans who expect their government to deliver economic growth at the same time as dealing with climate change. They're going to be very disappointed.
What would you like to see instead? Like you mentioned that 5-year gap. Would you prefer to see like a higher price implemented right away moving forward?
Well, the problems with what the current system in Alberta are well documented, and Alberta has not properly managed the system for the last several years, and so carbon credits are not trading at a price that will actually provide the incentive for companies to move ahead, and so what we were hoping to see was some immediate steps to address that problem in the next 5 years. And then some longer term certainty about where the price was going to go to, and ultimately get to a level that would compel companies in the oil sands sector to do the project that they've been promising Canadians for over 6 years now, to the Pathways project, and actually start to bend the curve down on oil sands emissions. Instead, we've got a weakened industrial carbon pricing regime that's going to affect carbon pricing regimes across the entire country. It's going to set a new precedent. And the price is never going to achieve that level that is going to result in emission reductions from the oil sands. And so we're sort of back to where we started over a decade ago, with no meaningful regulations or policy in place to address rising oil sands emissions.
I wonder, like, how does Canada compare to other global carbon pricing around the world? Are we behind?
We are, and we're not even just sort of part of the conversation anymore that's happening between the European Union, even China and India are talking about strengthening their carbon pricing regimes and making sure that that there's penalties for countries that don't have effective carbon pricing regimes in place when it comes to doing trade, because other countries are moving ahead with dealing with climate change in a more aggressive fashion, and they don't want to be competing with countries who are not following that same trajectory. And there's no reason why Canada can't be competitive, both in terms of growing our economy, the electricity strategy, if that promise is followed through with, and we'll be watching to see if that actually happens at budget time this year. That would really could put Canada into a position where we are able to compete with the rest of the world to grow our economy and address emissions at the same time. But that central to that is actually having an effective carbon price.
I'm sure there's a lot of people maybe listening who feel that having a proposed carbon price on the oil and gas sector here at home doesn't make economic sense. Like, this will weigh too heavily on so many of the oil and gas companies in Canada. What's your argument to that?
So our industry in Canada could do the project at $130 a ton, and it would cost about 50 cents a barrel. And so it's really a very small cost of doing business, and it would guarantee that Canada is not going to find itself in the future being a very high carbon intensive source of oil at a time when demand for oil in the world is starting to significantly move into decline. Some of the consequences of the extreme supply shock that have happened in the last several weeks are going to carry on for over a fairly long period of time here, and countries are going to be moving away from being reliant on foreign sources of oil and gas and embracing electricity and electrification at a greater pace. And so, you know, we have to be thinking about the future when we'll be competing for a shrinking demand for oil, and at a time when the carbon footprint associated with the production of oil and gas is going to matter in a way that it has in the past. This is an issue that's not going away. Climate change is only becoming more severe, and it's something that we are ultimately going to have to deal with as an international community.
It's definitely a very wide conversation to cover in such a short amount of time. Chris Severson-Baker, Executive Director at Pembina Institute, appreciate you joining us today. Thanks so much.
Thank you.
Still ahead, Prime Minister Mark Carney and Alberta Premier Danielle Smith are set to make that announcement on an agreement on the future of industrial carbon pricing. We'll bring that to you live after the break. Stay with us. Canada's manufacturing activity continued to rebound in March. Data from StatsCan shows factory sales rose 3% versus the month before to $74 billion. The growth was softer than the agency's advanced estimate, but still marked the highest level since the beginning of 2025. StatsCan says the results were driven by a spike in energy prices fueled by the Iran war. Okay, we're going to go live now. And Alberta Premier Danielle Smith are making an announcement on the future of industrial carbon pricing. We're going to listen in live now to what they have to say.
Coast Oil Pipeline would transport more than 1 million barrels of oil per day. This landmark agreement builds on the collaboration between the federal and provincial governments following the signing of the Alberta-Canada Energy Agreement, which was signed in November of 2025. Our governments have agreed to make targeted changes to our respective environmental policies that will lead to tangible outcomes that reduce regulatory uncertainty and create the conditions necessary for Alberta to significantly increase its energy production and exports to Asian and other markets. Today's implementation agreement also results in Alberta avoiding a significant increase to the federally mandated industrial carbon price, saving Alberta's industry partners approximately $250 billion in compliance costs over the next 2 decades to 2050. Under the new carbon pricing agreement, the industrial carbon price will be substantially lower than the previous federal policy, which would have required a carbon price of $170 per tonne by 2030. The headline carbon price will be substantially rolled back. It'll stay at $95 until the end of this year, and then it will increase to $100 for the next 3 years and reach $130 per tonne by 2035. This gives industry the time and certainty needed to plan, invest, and deliver real emissions-reducing projects without undermining competitiveness. It means that we're much closer to attaining our joint ambition to make Canada into a global energy leader and a trusted supplier of responsibly produced, lower emissions energy in the world. We've accomplished a lot together in less than 6 months. We've removed barriers that were holding back investment, like the clean electricity regulations and the proposed oil and gas emissions cap. And we've reached key agreements with the federal government on impact assessment cooperation, on methane equivalency, which we expect to finalize this year. Both governments also remain committed to working together with the Oil Sands Alliance, formerly Pathways companies, to advance the completion of the world's largest carbon capture, utilization and storage infrastructure project. At the same time, we're advancing the final submission to the West Coast Pipeline to the Major Projects Office by July the 1st. We're also establishing an electricity working group with the federal government to explore new low emissions technology, including nuclear, geothermal, abated natural gas, wind, solar, and hydrogen. As this work advances, the governments of Alberta and Canada remain committed to respecting constitutionally protected rights, engaging in early, consistent, and meaningful consultation with First Nations, and working with Indigenous communities to support opportunities for ownership and partnership. And I do want to sincerely thank the Prime Minister and his officials for approaching these negotiations in a genuine spirit of collaboration and in pursuit of a stronger, more secure, and an independent future for Canada. I also want to thank people across Alberta for their patience and for keeping faith throughout this process. Thank you, and I'll now turn it over to the Prime Minister.
Well, thank you. To be clear, I was clapping for the Premier there. I wasn't clapping for myself. I want to thank you, Premier, on behalf of the people of Canada and behalf of my colleagues, both in Parliament and my officials and your officials for the cooperative spirit and the hard work to get us where we are. As you said, we've accomplished a lot in the last 6 months, and we've accomplished it together, and I think that's the important point. You know, last week, the head of the International Energy Agency, Fatih Birol, visited Canada, and he spoke about the most important commodity in the world, something that Canada has in abundance, something that we're building today, and that's trust. Trust to double the reliable and affordable energy available to Albertans. As the Premier just said, drawing on all the resources of this great province, natural gas, renewables, extending potentially out to nuclear, geothermal, and beyond. We're building trust of investors, that Alberta and Canada are reliable and attractive destinations where opportunities are plentiful, the rules are clear, and one project means one review. The trust of Asian countries who want our energy because they know that we are a safe, stable, reliable partner in a world that is anything but. Today's implementation agreement is comprehensive and it's interconnected. It covers, amongst other things, regulation, markets, methane, renewables, and carbon capture. It includes, as you've just heard, Alberta's commitment to submit a comprehensive proposal for a bitumen pipeline to Asian markets to the Federal Major Projects Office by Canada Day, by July 1st this year, and Canada's commitment to pursue the designation of that proposal as a project of national interest under the Building Canada Act by the 1st of October. Now, earning trust, as we all know, it requires more than just ambition. It requires partnership and it requires cooperation. Cooperation that respects our duty to consult and ensures Indigenous economic benefits and opportunities for co-ownership exist in every project. Cooperation that recognizes British Columbians should share in substantial economic benefits from projects that impact them. And cooperation that will create tens of thousands of high-paying, rewarding, not just jobs, but careers across the skilled trades, engineering, and beyond. And today's agreement is also about creating a better world for our kids and our grandkids through major investments that will help put Canada on the path to net zero. Through a methane equivalency agreement that will lower methane emissions from oil and gas by 75% below 2014 levels by 2035. And through carbon markets that work. When we signed the MOU in November, an oversupply of credits had driven prices as low as $20 a ton, $75 below the headline price. And today, as you've just heard, Canada and Alberta have agreed to create markets that deliver an effective carbon price of $130 per ton by 2040, with binding annual benchmarks along the way. We will also issue 75 million tons of carbon contracts for difference to support major carbon capture, clean energy, other emission reduction projects, with the cost shared equally between us. In other words, we will have skin in the game so that that market actually works. Nous mettons en place un marché
We're implementing an efficient market that creates a certainty necessary for progress and to contribute to reach parity. So, renewable energies will be competitive thanks to new federal measures and encouraging measures. The most competitive measure is the one that is economically lowest.
Formerly Pathways, the largest global initiative for carbon capture and storage. And the proposed pipeline depends on that alliance, which will achieve emissions reductions equivalent to taking 90% of the vehicles off Alberta roads while generating over $16 billion in GDP as part of this overall package, which can create up to 50,000 jobs in Alberta and across Canada. Which brings me to Canada. Today is also about building trust in a Canada that works. A Canada rooted in cooperative federalism where we build together, pragmatically and ambitiously to achieve our shared ambitions. A Canada where our differences are strengths to be nurtured and respected, not risks to be managed. A Canada that's strong but good. A Canada that's not just prosperous but fair. Not just for some most of the time, but for all of the time. Let me finish on a personal note. Some of you know I was born in Fort Smith, just north of the Alberta border. I was almost born in Alberta. I was born in the Northwest Territories. But in many ways just not far from the oil sands. And when I was born, the oil sands were a concept, a curiosity to most, a dream to but a few builders. By the time I was in junior high with Alex Porbay, some of you would know I was in junior high with Alex Porbay, junior high in Edmonton, the oil sands had been transformed already by that point to one of Canada's largest industries. And it happened because of the brilliance of our scientists, the drive of our entrepreneurs, yes, the support of provincial and federal governments, and the dedication of our skilled workers. And that's the legacy that we're building on today. Carbon capture that creates an entirely new industry, an affordable, low-carbon grid that's doubled, that draws on all of Alberta's strengths, and a low-carbon oil pipeline that bolsters our independence. Building big, building fast, building bold again, building with trust, an Alberta strong and a Canada strong for all. Thank you very much. Merci beaucoup.
Okay, we've been listening in to Prime Minister Mark Carney and Alberta Premier Daniel Smith making quite the announcement there in Calgary. This is the headline. Ottawa is planning to greenlight an Alberta oil pipeline construction by fall of 2027 with the idea of having oil flowing by 2033 or 2034. There remains no clear private sector investor to pay for it, though. So that's one of the main points we'll, of course, be focusing in on. Prime Minister Mark Carney was saying Alberta can now, this is the timeline, submit an approval for that pipeline by Canada Day, and then Canada can pursue that by October 1st. So we also heard Premier Daniel Smith talking a little bit more about the carbon pricing structure, how that's going to work. She was speaking quite fast, so I believe I have the points here. She says it's going to remain at $95 a ton until the end of this year. And then over the next 3 years, it will go up to $100 a ton and then $130 a ton by 2035, eventually reaching that by 2040. Of course, that's the goal for the carbon pricing. You can see the Prime Minister and the Premier there shaking hands, signing that deal. They both were saying that this is to make Canada into a global energy leader. And of course, Prime Minister Mark Carney also saying that everyone will benefit from this. According to the Prime Minister, he also said British Columbians should share in a substantial economic benefits from this project that will impact that province as well. So for more on this latest announcement, we're going to bring in Derek Decloet, Bloomberg's executive editor for Canada. He joins us live. Derek, so many things to kind of pick out here. What exactly are you picking out from this announcement that we heard today from the Premier and the Prime Minister?
Well, I think the big theme here is it has to do with the environmental rules. And really, there was never a question about whether there would be an industrial carbon tax. I think it was a question of how high and how quickly, right? Because how quickly you implement a higher cost has a major impact on the economics for the companies that produce CO2 emissions. And so the overall theme here is, there's still an industrial carbon tax, and it's going to rise slowly over time. There is still a carbon capture project being proposed called Pathways, as has sort of been on the books for years, but no construction has started. It still exists, but it's going to be somewhat smaller and I think slower moving than we may have thought in the past. So what you have here is the oil industry getting significantly more time to adjust to these environmental measures, and in return, they get somewhat better economics. They won't all be happy, I suspect, but nobody is ever fully happy when you have to compromise on something, and that's sort of that's the environmental piece of it. And then, as you said in your intro, the pipeline, that's the other half of it.
What about the fact that there seems to be no private sector investor to pay for it yet? Is that kind of a red flag to you, or will that come in time? Obviously, there's a couple of months here before the federal government actually signs off on this project. But was that something that you picked up on?
I don't really think it's a red flag yet. I don't think anybody expected there would be private sector money coming out of the woodwork just yet. You have to get over a few hurdles. And I don't even think necessarily you need to find one by July the 1st, when is sort of the date by which we'll see the Alberta proposal. I don't even think they necessarily need to find private sector investors by this fall. Eventually, of course, this is a project that is going to cost tens of billions of dollars, and they will want private money to come in. But our information suggests that in time you will see those investors. Not that there won't also have to be government backing. It's entirely possible, if this pipeline gets built, that it gets built as a joint public-private thing. But we know that there is global capital out there that's interested in energy supply. In the case of liquefied natural gas, for example, we saw 5 really big companies step up to own that project in British Columbia. That's partly because of security of supply for Asia, and Asian countries now want oil supply to be secure.
Okay, we'll have to leave it there. Bloomberg's Derek Decloet joining us live to break that announcement down. Derek, thanks so much. And stay with us. We are continuing our coverage of the industrial carbon pricing agreement, that announcement that we just heard. More on that after the break. Stay with us. Prime Minister Mark Carney and Alberta Premier Danielle Smith met earlier to announce a new industrial carbon pricing program in the province. And for more on what this means for Canada's energy sector, we're joined now by Mark Parsons, Chief Economist at ATB Cormark Capital Markets. Thanks so much for joining us. Appreciate it.
Thanks for having me.
So I'm sure you were listening into that announcement as well. Now it sounds as though the province of Alberta and the federal government have kind of resolved the carbon pricing issue. How significant is that when it comes to getting some of these projects going?
Well, it's very important. It's a step in the right direction. This was a major hurdle. And so we have some clarity today, at least on the industrial carbon price. There were rumors it was going to be 130 by 2040. I think we know what that looks like now. It's 130 by 2035, but the effective price is going to be 130 by 2040. So there's a little bit of room or time for the industry to adjust to these higher prices. I think that's what they're hoping for. But I'm still cautious on this. I'm optimistic, but cautiously optimistic in that we didn't get an agreement. At least I haven't heard of an agreement between on the Pathways project between industry and the government. So still some work to do, but definitely a step in the right direction.
Can you explain for our viewers how important the Pathways project element of this whole story is for, you're saying today we didn't hear much about it. How important is that?
Yeah, and the Pathways project is the carbon capture and storage project, which is really, it's pathways for pipelines. That's the deal. Mark Carney has made it very clear that the federal government will not consider a West Coast pipeline without the Pathways project because it's an important step towards decarbonization. So the industrial carbon price is part of it getting to Pathways because, of course, Pathways doesn't generate any revenue. Maybe through the carbon price you accumulate some credits. So that is why we need more clarity on that project. My thought would be potentially the government could move on the pipeline without having everything figured out in Pathways, given some energy security risks we're seeing with the war in Iran. But it still looks like that's a big part of the deal.
Okay, going back to the carbon pricing side of things, because that was a big part of this announcement today. Like, how does this position Canada compared to other global carbon pricing plans that we see? Does this position us within the same realm of some other countries?
Well, no. I mean, it puts us much more aggressive on carbon pricing than our competitors, and I think that's the concern we're hearing from industry is saying, well, you're adding additional costs to doing business here in Canada. And so there has been some concerns around competitiveness. So this is what I'm looking for next is fantastic news that we're looking at advancing a West Coast pipeline. We need it to support our allies in Asia. We need to improve pricing and to get that next leg of growth in the oil sands sector and oil and gas industry. But are we going to be able to achieve this with the additional costs? So that's the big question mark right now. Now, if we get it right, we can do both. We can decarbonize, proceed on the Pathways project. We can, drive decarbonization and address global energy security. But we're going to have to thread that needle.
Okay, so many unanswered questions. Mark Parsons, Chief Economist at ATB Cormark Capital Markets. Appreciate you joining us and breaking that down for us. Thank you.
Thanks for having me.
And that wraps up this edition of Trading Day. Thanks for watching.